Is the flash crash over? That is the million-dollar question, and after Thursday's rally, the answer starts to lean more and more towards yes. But there are still one or two dangerous charts in the supporting evidence category that you should continue to keep an eye on. Welcome to the Trade Brigade Weekend Show, where we'll cover those specific charts, but more importantly, build a game plan for the upcoming week. My name is Matt, and if you're new here, hit the thumbs up button and subscribe so you don't miss out on future episodes. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly time frame so we can remain crystal clear on which time frames are bullish, which time frames are bearish, or where we need to change our tone from last week's opinion. On the monthly chart last week, we had expressed that this was a very clean uptrend, and we were pulling back from the highest high in the trend count. Of course, it was the all-time high as well. We had made note that any monthly higher lows that can sustain price over 480 would likely continue the trend in the upward direction. We had also pointed out that the most painful moments in market history typically come after the monthly trend has flipped to down. This is the Great Financial Crisis, monthly downtrend, big painful moment. As we continue looking left, we saw the same thing here in the dot-com bubble bursting. We have a monthly lower high, a cluster of monthly lower lows. The monthly trend is down here, painful moment number 1, painful moment number 2. If we compare these 2 instances to what the current monthly trend looks like, you can see that we're not even close to suggesting a monthly downtrend. And for that reason, in last week's episode, I was saying that investors should likely exercise patience. Patience meaning don't panic sell just because we were gapping down on that Monday, August 5th session. I actually took it one step further, and instead of just doing nothing, I actually added to my long-term portfolio, noting that this looked like a very strong monthly uptrend. The trend was bullish, and it remains bullish here. We could take it one step further and play devil's advocate. If you're trying to look for a deeper monthly pullback into 480, if you're a stronger seller saying, oh man, I thought this market was going to go for it on the higher time frames, what would you have liked to see out of the August bar? Certainly not price moving back into July's range, never mind over July's closing print. So once again, monthly chart was bullish, and it remains bullish. As we drop on down to the weekly time frame chart, this is where some more nuance is really required. First and foremost, I want to acknowledge that in last week's episode, I believe I said verbatim that there was a lower probability the weekly bar would close over the highs of the back-to-back inverted hammers, the 2-week balance range. Clearly, the market has proven me wrong. Now, if I could go back in time, I would make the same exact comment if the market was trading down here. But it requires that we change our tone on the weekly time frame chart because something unexpected has happened here. So let's keep it status quo and walk through candle structure as well as location. This, of course, for candle structure is a solid green-bodied bar, very self-explanatory, strong close from the buyers at the top end of the weekly range. If we're thinking about location, bar-to-bar count offers a massive higher low as well as a massive higher high. Buyers ultimately go 2 for 2 on the weekly trend count. The only issue and the nuance that's required out of the weekly time frame chart is that we can't ignore the fact that this is still a lower low, and there's still, technically speaking, an opportunity for a lower high. I would not be bearish on the weekly time frame chart, but I'm not convinced that this is fine and dandy, rainbows and butterflies, oh my goodness, here comes new all-time highs. It's definitely close. It is very close. And I would probably argue that the more time we spend over this level, or the more time we spend over this level, the higher the likelihood of at least making it to the all-time high, if not looking for follow-through in the upward direction. For the people who are trying to call for a double top, I would just remind you that a double top pattern requires a lower low underneath the neckline, which would be a breakdown underneath the August 5th open. Seems like lower probabilities, I might bite my tongue on that one, but it seems like lower probabilities after the 2 bars we've seen on the weekly chart here. The reason I was so intent on the lower high sticking underneath the bottom end of this range, if you recall, was because we had the weekly anchored VWAPs offering confluence for potential resistance, set a weekly lower high, and then continue the trend in the downward direction. We also know if we bring out the Fibonacci's from the bottom here up to the all-time high, we had the 38.2 also mixed in around this area. Again, a decent opportunity for a potential higher low. Obviously, or excuse me, lower high, my apologies. Obviously, that did not take place, and we did get that strong close over the top end of the 2-week balance range, hence the change in tone. The last thing I'll say from a Fibonacci perspective here is that if you take the fib from the all-time high to the low of the Bank of Japan meltdown, if you will, what you'll notice is that we've got a firm weekly close over the 61.8. And what this would now indicate is that the odds are actually increased for a 100% retracement into the equal high here on the weekly time frame, which would imply bullish pressure. You could flip all of this on its head and say now, if there were a pullback on the weekly, ideally, you would hold this area right here around 541, 543. It's a little bit of a zone. We'll refine on the daily time frame chart. But if this is going to offer a higher low, that would be bullish back to the all-time high. The final indication on the weekly time frame chart comes from our volume profile. And we can drop this down to a 6-month chart, just reinforcing the actual strength that showed up this week, right? This was confluence. Remember, the anchored VWAPs were right here as well. It was a high volume node. If all of this was going to remain as overhead supply, that was the best opportunity for the sellers to try to make something happen, and it clearly didn't. You could make a similar argument about this level right here, also a high volume node. Once again, we're acknowledging the change in tone because there was zero reaction from the sellers at both of these two key levels we've identified so far, which had some pretty solid confluence. Let's drop this down to a daily time frame chart, and let's get granular here. First things first, we'll evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. The upper bound is about 562, and that would imply a higher high. If we're contained by the lower bound, the number's at 546.75. That is clearly a massive higher low. The expected move here is undoubtedly bullish. One caveat is that I would not expect the market to necessarily be contained by this week's expected move. Last week, that was the expected move, yet we closed all the way up here on something like a 2 or 3 sigma move outside of the range, correct? So don't hold your breath. These are not do or die levels, but the suggestion is that a new uptrend is likely going to occur. So speaking of trend, let's get into it. The previous trend was down, right? We had highs, lower highs, and this was only a soft lower high because the hourly trend never firmly went down. We never ended up taking out the previous day's low. So for that reason, this was the last lower high in the trend count. That's exactly where we found ourselves at the high of day on Thursday. So in the intro, when I said Thursday's rally changes things, that's because now we have an equal high on the daily time frame chart. The downtrend is certainly over, and I would argue that we're in a neutral trend looking for a higher low to confirm a new uptrend. So what are the handful of locations where a higher low could be found? And this is assuming pullback first, right? And we'll get into the supporting evidence which says yes or no on that. But a gap fill reversal is about, as picture perfect as it gets. That's the highest higher low we could look for that is reasonable based on structure. That's under 549, closes the gap into 544.85. You'll also have confluence out of your daily 50 SMA meeting you there for support. You'll be close to the lower bound of this week's expected move as well. That's step number 1. Step number 2 would be a slightly deeper pullback, and we'll look for the same thing, double bottom on the hourly or something of the sorts, for a reversal at what I'm calling the ideal daily higher low, and that level is at 537. Why is that the ideal daily higher low? Because it would keep us inside of this previous balance range. You can think of it like this. While we were still in the downtrend here coming off of the lowest low, the best place that the sellers could have offered a lower high, which was why I was so bearish in last Saturday's update video, was right here. So if we can now hold that as a possible area of support, of course that would be bullish. And if I back this off, there we go. This starts to imply what? We've got a left shoulder, we've got a head, and we've certainly got a right shoulder for an inverted head and shoulders, pie in the sky, sure. But break the neckline, and I think we're right off to the all-time high. So that's the ideal daily higher low, 537. The line in the sand, higher low on the daily time frame chart, would actually come from the double bottom neckline, which is on the hourly time frame chart. It looks like this, and your level is at 532.50. The reason that this is not really ideal is because technically, and keep in mind, look at how far extended that would be through the lower bound of the weekly expected move. I'm not going to hold my breath based on what happened last week, but again, seems like it would be lower odds under normal market circumstances. If we find ourselves here, you could still get a higher low from the low up to this area. However, the threat then becomes that the sellers now have a second chance, and that would be a lower high underneath the balance range from back here. Do I think that this is a high probability into the upcoming week? I would tend to think not, but I'm just trying to arm you with the possibilities here of the trend follow through on the daily time frame. Matt, what about continuation in the upward direction? Absolutely bullish, right? We have a low and we're sitting at an equal high. If we continue for a higher high, the trend is starting to confirm in the upward direction, but the actionable trade ideas up here become really difficult to participate in. If you're chasing the highest high, typically your location is not good from a risk-reward perspective. So if this market continues and possibly comes up and tags the gap, I would prefer to watch for the next higher low pullback to confirm over this equal high test at 552.75. And that, for the most part, is everything I'm seeing here on the daily that is strongly suggestive of changing tone from bearish to now being open-minded to a higher low and looking for upside. I do want to bring in the Fibonacci's on the daily time frame chart from the all-time high to the pullback low. We also looked at this on the weekly, right? But look at the confluence here with the 61.8. If we do pull back for a gap fill reversal, that would be an awesome spot for buyers to step up and possibly try to rotate prices back up into this equal high, which at that point would then be considered a neckline. Let's bring this down to, well, first of all, speaking of gaps, like we didn't even talk about the candle structure here. There's no indication of a pullback, right? Solid green bodied bar, looked into the previous day's range, closed over the high, gap and go, closed over the previous day's high. There's zero indication of a daily pullback triggering here. I would be highly attentive to Friday's low, and you'll see why on the market profile in just a second. If we had stronger sellers stepping up in this market, they should have sold at two places here that I can see on the daily. Number one would have been the Tuesday gap up into the bottom end of this range. That would have been an awesome spot for a lower high to persevere and move the market to the downside. Stronger sellers did not show up. The next place where stronger sellers should have showed up would have been on a rejection for Friday underneath this level here at 552.75. We opened inside the prior day's range. Again, if we had stronger sellers, put yourself in the shoes of the sellers, they should have looked for a rejection of the Thursday high and possibly started to close the gap, or the gap should have faded on the Thursday open. Neither of those two outcomes took place. We do not have stronger sellers stepping up in this market. It seems as though this was a hit the panic button and right back in the upward direction, V-shaped recovery. We're changing our tone. The market tells us when to change our tone, and we can even see this. There was an additional data point that we were using. It was this resistance trend line off of the all-time high. Thursday changes that with the gap up and over the trend line, completely breaking it and not looking back whatsoever. Let's go on down to the hourly time frame chart, and we'll keep it very basic, right? What's the trend here on the hourly time frame? It's certainly up. Lows, higher lows, higher lows, higher lows, higher lows on the gap up, higher lows intraday here, higher lows intraday here at the Friday low. And that's going to become a key level. We should probably mark it off on the chart together. This needs to be at 551.50. 551.50 is that level. Friday's low and also the pullback low intraday from Thursday. You'll see why in just a moment. Obviously, along the way, higher highs, and we're sitting on the highest high. So if this is going to yield a pullback, this should turn into overhead supply, and the thin structure really starts to break down when we're under 551.50 to get into the gap. Now, when we close the gap, if we close the gap at 544.85, I would be thinking about double bottom. I would try to execute longs here and trade into the equal high, then look for continuation into the areas overhead. The gap overhead, just as an FYI, is 560.50, closes at 562, upper edge of the weekly expected move. If the market does not suggest that buyers are stepping up for a double bottom, and you guys know the deal, it could be double bottom, it could be inverted head and shoulders, it could be an hourly hammer candle, correct? So if we do not get that indication on the gap close and the daily 50 SMA, which also is the 61.8 Fibonacci we were just looking at on the daily, the next place to look for would be, okay, if we break through it, let's just say lower high underneath, you're looking at your ideal daily high or low, which is at 537, the number we were just describing as the bottom end of this range, right? So rinse and repeat. Where's the double bottom? Where's the inverted head and shoulders? Where's the hammer? And we're looking for that particular buy setup at 537, right? Looking for that rotation back in the upward direction. It doesn't mean that you can't scalp this market short this upcoming week through the gap close. If there's a move to move with a lower high underneath 551.50, by all means, you can try to take a scalp from point A to point B to close the gap, I would just encourage you to keep in mind that this is a counter trend move in the context of an uptrend that is now fully formed, at least on the hourly chart, and we're looking for a higher low on the daily, correct? So that scalp is available underneath 551.50, but we're not overstaying our welcome, and we're not overstaying our welcome. Where the market gets far more interesting is if something like this starts to emerge, as we've made note, seemingly, I'll bite my tongue, lower odds for that. If the market's going to continue in the upward direction, like we said on the daily, this is very difficult to chase, but price acceptance over 557, you could possibly look for that gap close overhead, point A to point B trade up here. It's interesting if the risk reward presents itself in the correct manner. You would want to be able to do something that looks like this. If there's no place to put your stop loss, typically chasing new higher highs after a 100% retracement on a move, not really the best trade location, right? So that's why we've talked so much about the pullback, because the market, for a lack of a better term, is somewhat extended here at the equal high without offering a higher low before continuation. Let's bring out some additional indicators like the intraday anchored VWAP, and what we'll see here is that we're still getting some decent confluence out of these areas. I would say that slowly this will move here, and the concept would be if there's a Monday breakdown, or maybe it's like Tuesday, if we can crack this VWAP, great. The gap close is the trade we're looking for from point A to point B. From there, we'll take it back in the upward direction. If we move lower than that, it's very possible that the market gives us some sort of setup near the ideal daily high or low and the anchored VWAP coming from the all-time high. Anything underneath that, this line in the sand is being reinforced by the 100% retracement origin, that's this right here, the equal high, as well as the lowest low in the current trend cycle. That number is at 532.50. There's really no need for Fibonacci's, I don't think, on this from here to here. I guess just reinforcing the ideal daily high or low, 537, that works out just fine. But let's move along to the market internals and see what's going on from this perspective. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. Generally, on Thursday's breakout, did we have strong volume inflows? Absolutely. Look at this. Well up and over 300 million into the close. Net flows on the week are substantial, over 500 million. If we're looking at the advanced decline line, it's near trend higher zone all day. And the index score also prints positive impressions near trend higher zone. Not quite as strong as the Tuesday move in the upward direction. This was the PPI breakout. This was the retail sales and jobless claims breakout. But generally speaking, intraday, it made sense that the market was moving higher. The cumulative tick was the strongest on Tuesday. That was the PPI release once again. And Thursday was a little bit more lackluster out of the cumulative build. But notice, as Friday was inside the prior day's range, it was actually stronger than Thursday's breakout. What I'm getting at here is there's not enough of a divergence where I would say, oh my goodness, the market has to crash in the downward direction to give us this beautiful pullback. No, the internals are very supportive of new money buyers getting active in this market based on volume flows, the advanced decline line, index score, and the cumulative tick down below. If we take a look at the market profile, this is one of the pieces of the puzzle that would suggest Friday's low is important because it's a mechanical level. And we saw it on the hourly chart, but I'll reinforce it here on the market profile. If you're not familiar with the profile, check out the video tutorial in the top right-hand corner. Two things. We're leaving it zoomed out first, so you can just see that a bulk of the value is down here at the double bottom neckline. So if a really deep pullback does unfold, it wouldn't be unreasonable for this area to act as support, right? That's the first thing on the zoomed out view. The next thing on the zoomed out view is that we've basically, recaptured the VPOC, virgin point of control back here as this gap was taking place. We've got the thin structure retracement. This has been traded through. As we zoom in on the Thursday and Friday session, this is where we sort of come to terms with Friday's low being influential. If I do something that looks like this, value area low on Thursday, low of day on Friday. If you break down below that, longs late to the party, value area here, are likely going to close out and a pullback may ensue. Again, this is not a guarantee that the market is going to pull back first, but I am very interested in the possible breakdown of Friday's low to at least offer or kick off some kind of pullback. As we've made note on the daily time frame chart, hourly time frame chart, in the internals, there's really no indication of stronger sellers stepping up, so it's likely going to be a pullback in search of a higher low until proven otherwise. Let's bring this on over now to the QQQ NASDAQ and do the same exact thing. We can start on the monthly time frame chart. We won't be as detailed about it, but what you'll notice is we're in a monthly uptrend. We didn't even get close to the previous all-time high. This is a monthly high or low, and we're already back inside of the July range. Sellers didn't really make much meaningful progress, especially noting this was the all-time high. Weekly time frame chart, same concepts as the S&P, except there you have it. The possibility for a lower high is still available on the QQQ NASDAQ. There's more of a threat out of the QQQ. So we're still using that same exact 2-week balance range, but because we were coming from so much further underneath, I would argue that this is now still, or I should say it still is rather, an opportunity for a lower high to present itself. If we find that the market's rejecting this early on in the week, on the daily chart, we'll worry about higher lows, but the weekly lower high threat is certainly something to consider that we did not have out of the S&P. If we come in from the bottom of the move with the Fibonacci up to the top, we did close over the 38.2, so that's progress in the upward direction, but it's not rainbows and butterflies yet. Let's come in here with the volume, or VWAPs, I should say, anchored VWAPs on the weekly. We're over the cluster, yet underneath the structure. Structure always reigns supreme. You guys know that if you've been tuning in for long enough. And the final thing we'll check in on, and you can probably imagine what this is going to look like already, is the volume profile. We're underneath the high volume node, right? If I go down to the 6-month, I do something that looks like this. This is your high volume node. We're right at it. We're right underneath this one in here. So the threat seemingly is higher on the NASDAQ for a potential change in trend out of the medium time frame weekly. All right, that's fine and dandy, but what does the daily chart have to say about that? And is it likely that we're going to reject here? Well, let's take a look. First and foremost, this chart is like Swiss cheese. There's hardly any structure anywhere on it. But as we're looking at this, what do we see off of the lows? Was there a rejection of the bottom end of the balance range here for the ideal daily lower high? The answer is no. Okay. Are we still getting the gap and go strength that we got out of the S&P? The answer is absolutely. The only minor difference I can see based on structure is the fact that we were unable to really close firmly outside of the Thursday high of day. So this brings me to my sort of first maybe tactical point, which is just if you're looking for a short in the market this upcoming week, if you're looking to participate in the pullback to the downside, the NASDAQ is probably where you want to do something like that. You're still rejecting possibly this overhead supply, but when we come into the gap close, when we come into the ideal daily high or low zone, are you going to overstay your welcome? The answer is still no. If we had stronger sellers, we talked about how this should have rejected. That didn't happen, and now we have at least an equal high. We're at the daily 50 SMA. Is it possible that a pullback here yields a higher low, and then we're dealing with the inverted head and shoulders? Absolutely. So shorts for the pullbacks are probably more impressive on the NASDAQ. S&P, you're looking to participate when and if we could find the higher low on that S&P 500 chart, right? So what are the key structures? If we break underneath Friday's low, the gap closes down to the lower bound of this week's expected move. Under 468.35 closes 465.25. The line in the sand here, or I would just say the ideal, rather more appropriately, ideal, daily higher low is 459.50. Line in the sand is actually down here, which might seem crazy, but that's it. It's at 448.15. Right? If you get this pullback, there's nothing saying that you can't get a higher low from here to here, but the threat once again just becomes the lower high and possible breakdown into the future. We'll take that in stride when and if it happens, but it seems like lower odds right now. If we continue in the upward direction, there's immediately a gap overhead. I would say that if this gap can close, a gap fill reversal in a picture-perfect world on the daily chart then wants to hold over 475 for a very nuanced higher low and possible continuation into the next gap. Again, this is an absolute Swiss cheese chart. We have 488.50 closes at 493.10 on the top end of your screen here. That's the daily analysis. We can come in with the Fibonacci's, just like we did on the S&P. And what we'll see is that the 38.2, if you inverted this, right, obviously it would be the 61.8. If we can hold over this, great. It's very likely that this is a secure low down here from August 5th. And the more time we spend potentially over the 475, the higher the likelihood that we try to navigate back up towards the all-time high. Let's go on down to the hourly time frame chart out of the NASDAQ, and we can see all the same indications. You probably want to focus on this level right here. That's going to be 472.50 we'll round down to, round numbers only up here in the penthouse, as your sort of gatekeeper for a pullback first. If you're consolidating over 472.50, no shorts. If you're under 472.50 with a lower high, looking for the gap to close into the Wednesday high we just talked about, 465.25. If the market's breaking out to the upside, remember that this, let it go. I wouldn't really chase it there. You're longing at the highest high. Risk reward's not ideal. Then I would wait for the higher low pullback potentially to offer some sort of indication here over 475. Or if that fails, that's also a very reasonable outcome, right? Something that looks like this, closes the gap, comes back down underneath, then I would look for the same exact thing, rinse and repeat. Longs here. If it goes further, longs here. If it goes further, this is the complicated factor down below, the possibility for that then flipping. We'll deal with that when it comes up. As of right now, the primary outcomes on the QQQ NASDAQ will be consolidation, break lower high, looking for this. If it goes further, same concept down here. If we break out, great, this is perfect. If it's a fake out, lower high underneath, then looking for this, rinse and repeat, right? That's how I would approach the NASDAQ as we come into the early stages of this upcoming week. We'll come in here with the anchored VWAPs intraday. You're going to get your ideal high or low right there. You're also going to get your gap close anchored VWAP and your line in the sand. It's actually slightly above on the cluster currently out of the NASDAQ coming from here and the bottom end of the move overall. So generally speaking, I think that the pullback has some merit to it out of the NASDAQ. I would lean into this possibility if the market opens up weak on the Monday morning session, under 472.50. Let's take a look at the NASDAQ internals. Is there any big discrepancies out of this? The answer is not really. Strong volume inflows, no indication of stronger sellers. Same thing out of the advanced decline line. The cumulative tick is also stronger than what we had on Friday. So this makes sense to me in the NASDAQ that Thursday should be respected, in the sense that if we are going to short this, it's a pullback only. I want to be very clear, right? I think I've been clear enough so far today, but these are uptrends, and if you're shorting for this gap close down below, it's a counter trend move in the context here of an existing hourly uptrend. I love saying it that way. Counter trend move in the context of an existing uptrend. Do not overstay your welcome on the short side, right? So that's what we have out of the QQQ. Let's bring this on over to the, I guess we could take a look. We can be congruent and take a look at the market profile. Let's check out the NQ. And as we zoom out, right, you can see here is your cluster of value down below. So if there is a larger pullback, not the worst thing in the world. We've rotated through the thin structure up here, so that has been taken care of. If we zoom in on the Thursday, Friday session, you're going to get the same exact indication where here is your value area low from Thursday, there's your low of day from Friday. So Friday's low is the gatekeeper. If you break down below that, that's where deeper pullback, I shouldn't even say deep, but rather just the gap close really comes top of mind out of the NASDAQ, right? That is what we've got in the NQs. Let's go back on over the platform. Let's get into our small caps here via the IWM. We'll go on out to a monthly time frame chart. We'll do the same top-down sort of approach here, and we'll do the dance. Let's grab a little bit more time. I want to be able to show you prior to the sickness, if you will. So this trend here overall has still remained up. You've got lows, higher lows. Ultimately, I get it. There's a lower high or lower low here, but from here to here, big cluster. And the main fact of the monthly chart IWM small caps is that the 50 SMA, the top end of this balance range right here, no ifs, ands, or buts about it. It needs to hold. And the reason being is that we're not pulling back from the highest high like we are in the S&P or the NASDAQ. Those charts are strong because the trend is clearly up. You've got new all-time highs within striking distance, whereas the IWM is not the case. If this is a lower high double top, all of a sudden back into the range under the monthly 50 SMA, look out below. I don't want to get overly aggressive here and suggest 100, but you get the idea. It's not constructive for the longs. So the fact that the monthly bar is already starting to find some support off the top end of this balance range does strike me as being slightly constructive. We'll move on down to the weekly time frame chart and see what else we can learn here. So again, this is that same exact level. You can see the two bars in the upward direction. And the best thing about the weekly time frame chart is just the fact that the weekly bar had closed above the top end of this micro balance. If this is the major balance, you could maybe call that the micro balance. And we did close the weekly bar above. That does strike me as a great first step in the upward direction. The only issue is we know that there's overhead supply here, which we'll see on the daily chart. So walking forward, is the weekly bullish or bearish? I would argue it's neutral right now, trying to battle back into bullish territory. It's neutral, very, very close to being bullish. I like the close above, but there's still a decent amount of overhead supply. If we bring out some of our the additional indications, this cluster for the monthly higher low thesis is still making sense. I like that. If we come in here with the Fibonacci's from the bottom up to the top, are we back above the 38.2? Yes, we are. So all set on that front. You've also closed over this most recent pivot high anchored VWAP as well. That one was kind of sneaky, not in the cluster down here. So that is a solid indication. So maybe it is slightly more bullish. And this is the beauty of like doing this in real time. I'm changing my tone in real time with you. This is probably slightly more bullish out of the IWM, the neutral, that I was perhaps expressing right out of the gates. Let's drop it on down. I guess we could do, let's be thorough in the investigation. We'll go to the weekly volume profile as well. And we'll go out to, I guess we need all 3 years, unfortunately. We're over the top end of this cluster right around in here. So we're in the low volume void. And in theory, this should start to act as a volume magnet, which is a little bit higher, closer to about 223. So bullish is sort of starting to become a little bit more reasonable now out of the weekly time frame chart, now that we've conducted that analysis together. If we drop it on down to the daily time frame chart, this is kind of that overhead supply I'm still somewhat worried about. The trend still has an opportunity for a lower high here. I would say that this breakout is, again, it's a good first step, but if this just rejects the bottom end of this, not all the way there. So now you can start to see maybe where my hesitancy was coming from. The best thing that the IWM could do is really resolve this box right here. Up or down doesn't matter, but if we're looking for a cleaner indication, if we want some easier to read impact for the S&P 500, you want to be over 418.80, this neckline ultimately of the double top, or you want to be under the weekly top end of the micro balance, which is at the 209.75. So let's not get too sidetracked here. What do we see in terms of the weekly expected move? It's probably bullish, looking for a higher low if respecting the lower bound there at, $207.75. Daily 50 SMA, the breakout point from in here, if you could hold that, it's so close to the top end of the weekly balance range high that I would consider that constructive. An equal high attempt here, I would look for the pop and possibly break out to do something like this if we're trying to maintain a bullish stance. If we fail underneath this area, kiss it goodbye. That's kind of a nail in the coffin for the S&P 500. I would have some slight, concerns about continuation in the S&P. If the IWM wants to show us a big breakout, like right out of the gates Monday, and do something that looks like this, ultimately that would also be bullish. My only reservation with that idea is look at what happened on Friday. More similar to the QQQ versus the S&P. You looked over the Thursday high and then failed to close above. You closed back inside of the Thursday range. So does it seem like a pullback would be reasonable here? I think the answer is yes. Classic inverted hammer, break Friday's low, pull back into this zone, and that's where we're looking for the resolution. Let's take it on down, and I know we're kind of jumping around here a bit, but Fibonacci's to stay congruent. 38.2 is in the cluster. That would be bullish if we could hold, and the best thing would be if we could get over the 61.8 to indicate the 100% retracement. So for the most part, I think that this is adding confluence to this zone mostly down below. 207.75, 208.85 is the gap close to Wednesday's high. Really interested in potential support around that area. Here it is on the hourly time frame chart. What else can we learn about small caps in here? Not a whole lot. The breakout attempt was early on the Friday session, and it sort of failed into the afternoon to really try again up and over that level. That might be something to take away. Just again, we're not getting that continued momentum out of the buyers, which is kind of noteworthy considering that this is a thin structure range. The small cap buyers were unable to really rotate through all the way into that low exactly at 214.80. So a little bit of exhaustion perhaps on the buy side, and that pullback does seem reasonable into this zone. I think that's ultimately what I'm getting at here with our deeper look. Let's take a look at the intraday anchored VWAPs. Clustering, I like that. Rejecting, I like that. So just reinforcing the levels 214.80 and down here 207.75. And that's really it out of the IWM hourly. Let's jump on into the Russell internals. Strong volume inflows on Thursday, over trend higher zone on Thursday, strong cumulative tick on the Thursday session. So generally, I think that everything is adding up to new money buyers have started to step up here. There's really not much of a huge concern that sellers are like lurking in the shadows, ready to pounce on any opportunity here. If that were the case, you likely would have seen stronger bearish internals on the Friday session, and that wasn't the case in any of the indexes that we've looked at in today's session. We'll finish it up with our Rusty Russell market profile, and there is a difference here, and there's a reason that this one started zoomed in. I actually did my homework ahead of starting the video today, and what you'll notice is that the value area on Friday is just completely contained within the Thursday range. And this is exactly what we were talking about with the upper wick on the hourly chart as well. So generally, this would just mean that there was a lack of attempt to continue to move price or find value in the upward direction. It was just totally inside of that Thursday range. We repaired the poor high, but that's really it. There was not much follow through there. So once again, a pullback out of small caps, maybe to repair the poor low even on the Friday session, seems very reasonable based on all the information I can see, and this is adding up across the broad market as a whole. Let's jump back on over to the platform and finish the job here with our supporting evidence. First things first, we always take a look at the sectors and their weekly performance. Who was leading the pack? It was, none other than the semiconductors. My apologies. ETF up 9.56%, followed by the technology sector, heaviest weight risk on sector. XLY is up there. That's consumer discretionary. That's fourth heaviest weight sector these days. So definitely more, it's a solid bullish indication. Financials up nice and green, 3%. And this is not some sort of skew where we gapped down underneath the previous weekly's close. This is a pretty accurate reflection of what actually took place versus last weekend's update where the numbers were all sorts of wacky, right? At the bottom end of the barrel, it's not even down. It's just the laggard. It's real estate, energy, and then down here, utilities as well. Let's check in on the structural charts and evaluate what's going on. So posture has flipped slightly to more of a risk-on stance here. As we take a look at semiconductors, the main concept that I want you to drill into your brain from this V-shaped recovery is, was there an opportunity for a lower high? And if so, did the sellers take it? Well, on the SMH, there was absolutely an opportunity for a lower high, but no, the sellers did not take it, and now we have an equal high. So walking forward, just like the S&P 500, this would be constructive for a continued reversal of trend back up towards these highs. This is a bullish-looking chart. Let's take a look at the XLK. Same commentary. Where was the opportunity for the lower high? Right here. Did the sellers take it? The answer is no. And now it's not even an equal high, it's a higher high out of the XLK tech sector, the heaviest weight risk on sector for the S&P. So you tell me, is this bullish? Absolutely. Is this bullish? Absolutely. Could you even argue that something that looks like this is bullish? Absolutely. So the sellers really failed a massive opportunity here, it would seem, to really start to suggest that in the short term, the trend would continue lower. As of right now, this is a very, volatile V-shaped recovery. However, noting the structure that it's cleared back above, there are opportunities for bullish setups to emerge from this. XLY, at the very bottom end of the range. Rejection of the gap in here was possible. This actually sets up an island reversal off of the lows, right? You've got this cluster of price action. You gapped back over it. As long as we're over 181.25, really it's the low of the Thursday session, 180.40. If we're above that, this is possibly bullish pressure into the top end of the balance range looking for a breakout. Right? So this is not bearish. Even if it goes for a gap fill reversal off of 177, that's a higher low in the midpoint of the range. I would argue that you really don't have an executable edge, maybe in terms of being in this range overall, but it's definitely bullish, trying to find a higher low, right? Next up, we've got the XLF. Right back to the all-time highs, basically. That's this double top up here. Once again, did the sellers have an opportunity for a lower high? Yes. Did they take it? No. So now that we're back up towards this equal high, this is a higher low. This keeps us out of this range. And we know that financials have really been a motivating factor for the S&P, remaining bullish even as the core list of companies, aka the Magnificent Seven, really started to break down. This, again, the sheer lack of willingness from the sellers to try to attempt a lower high and reject any of these levels, it required a change in tone, really Wednesday, but firmly on the Thursday session of last week. Next up, industrials. What do we see? Nice little move to consolidate over the top end of the balance range. Once again, where was the offering of a lower high? Anywhere up against here. Gapped over on Thursday, Friday. Not bearish. Got to speed it up a little bit. Materials, midpoint of the range. More so a neutral data point. Consumer staples breaking out. Technically a D for defensive sector, but how's the performance on the week? It's not leading the market for sure. So I would just argue upward pressure is upward pressure. Healthcare. It's the second heaviest weight sector these days, and it's breaking out to brand new all-time highs. Bullish pressure, upward pressure is upward pressure. It's not towards the top of the list. It's doing all right. DLT, just for the sake of talking about it, we'll talk about bonds in just a moment, but it's really just compressing. Obviously, we know that the Fed is likely to cut rates, so bonds moving higher made sense in there. And just as we consolidate, we'll watch to see, okay, as long as we're over 94.50, thinking about higher, if we break out over this, great. Maybe that's a little bit more of a risk-off rotation. People flight to safety into bonds, but we're just not there yet. As the market's ripping and roaring to the upside on this V-shaped recovery, bonds are really stable and going sideways. Not really as concerned with that. XLC, what's going on over here? Once again, where was the opportunity and was it taken? Absolutely not. Bullish for the market. Utilities, it's the most bond-like sector. Not surprising to see it sort of wedging like the TLT. If it breaks out, it's bullish pressure. It's not outperforming. Energy, I would have liked to see energy perform a little bit better. You can see that this still is like, was there an opportunity for a lower high? Yes. Did the sellers take it? Maybe. We don't really have the resolution of 90.25. So unless we can get up here, I would be slightly concerned still about energy and maybe a back pocket reason to be thinking about that R word. When I said in the intro that there are a couple of dangerous charts to be thinking about, this is one of them. It's just energy not being able to move with the market as firmly in the upward direction. Real estate, rate sensitive, not a shocker to see it sideways up here and really starting to threaten an ascending triangle breakout on the brink of rate cuts. So all set out of the sectors. Generally speaking, mostly a risk on rotation starting to come back underway with some concerns, right? We're not all the way out of the woods yet. There are opportunities for big, like major sweeping monthly lower highs, but the short-term trends have improved dramatically over the end of last week. Let's jump on into the ratio grid, and this is going to tell a slightly different story where the tech sector, it's improved, but the ratio could still technically find a lower high. I would argue it's a bit more nuanced than that, and the fact that this is not rejecting as cleanly is actually slightly more bullish. So yeah, I still respect the 50 SMA, but I do like the higher high that was technically produced here. The XLV pulling back has the opportunity for a higher low that would be defensive and more risk off. I like that financials are sort of doing this, but it would have been better for this to break at least to an equal high as we were moving to the all-time high in the structural chart itself. Not the end of the world, and this continues to be a bullish data point for the market, but I thought it might have performed a little bit better. It didn't. XLY is still clearly a concern. From here to here, still offering a lower high. So the structural charts made huge strides in the upward direction. Now it's all about finding those higher lows and continuing those trends. If we look at this, still an opportunity for a higher low out of defensive staples and still an opportunity for a higher low out of defensive utilities. Again, supporting evidence charts start to suggest, the structural charts look great, but the ratio, still leaves a little bit to be desired. If we look at risk on versus risk off in a couple of these indications, you'll notice a nice recapture of this level. This should have acted as a lower high underneath if the bears were going to remain in total control. I wouldn't say that this is like the best looking chart ever, but it's certainly an improvement. This one, unfortunately, is lacking any major improvement. It's got an equal high V-shaped recovery, yes, but any sort of drift to the downside is risk off. This up here, this is versus the S&P, this is versus the S&P, this is versus the XLP, so consumer staples, and this is versus healthcare. Just to give you a quick run through of what these are all comparing, what the ratios are. Still a threat for a lower high in here, but I do like the look below and fail, the beginning stages of that. If this can higher low here and rotate to the top, that'd be constructive for the S&P. And over here, you are getting a hold out of semis versus healthcare at the 1.49. You didn't really get much price acceptance underneath there. Unfortunately, there's still an opportunity for a lower high. So a deeper dive through the risk on versus risk off sectors and those ratios aren't fully out of the woods yet, but it's one of the only data points that's still sort of saying like, take it easy here, don't flip to a full bull just yet, which I think makes sense based on the weekly analysis we had conducted. There's a lower low and an opportunity for a lower high, but we really don't want to remain aggressively bearish. This is the USD JPY, and let's just flip this over to a candlestick chart, so we're looking at something that's a little bit more reasonable. What I want to point out about this is everybody was like an expert overnight in the Japanese yen trade, and oh my goodness, markets are crashing, this is why if it continues lower, and then everybody forgot about it, right? Everybody sort of forgot. Well, still, if we measure from point A to point B, this is just offering a lower high opportunity, and we actually have a really severe reaction off of that on Friday's session, the 38.2, classifying this as just a bear flag. So the broad market S&P US equities have immediately reversed back to the upside, but have we seen really substantial improvement in what had caused a decent chunk of this drawdown in the first place? I would argue the answer is no. I mean, we didn't even make it into the 152 level, which we had been watching for like about a week prior to this breakdown over here. So the fact that the yen remains weak like this, I think, is still something that you should have in your back pocket. It's one of those charts, again, in the intro that I was mentioning, you should probably keep an eye. Keep an eye, because if this takes another leg lower, and we could use something like 146.50 in here. If this turns into overhead supply and there's another capitulation down towards these lows, U.S. equities are likely going to feel it to some degree. All right, so keep this one on your radar. Let's move along to, let's take a look at the QQQ versus IWM. This is a chart that we had looked at maybe briefly once or twice, but this, generally speaking, has resolved for a rough higher low. The only reason I would say rough higher low is because we are from the highest high. We want this to be in an uptrend if the longer run trend of the markets are going to continue higher, right? A preference for the mega cap tech versus the slightly more risky small cap stuff, which generally doesn't return nearly as high as a percent return, right? Let's come on over to the dollar, which is breaking down. Makes sense given what's happening with all of the fundamental data that's been coming out. So this move to the downside is all set. If this continues to break down, in theory, that would alleviate some pressure on equities down below. And gold also agrees. We haven't looked at gold recently, so let's do that now. Breaking out over the top of this consolidation, even over these highs into the end of last week. And just as a general reminder, the 5-year monthly chart doesn't do it justice. Let's go to the max available. This is a huge cup and handle that still has room to run on a measured move in the upward direction. So please keep that in mind out of gold, which would further the downward pressure on the dollar, alleviating pressure on U.S. equities. The only issue with that is that typically gold is seen as a flight to safety style asset. Let's jump on over to interest rates and see what's going on here. So pretty stable. And I would argue that this chart doesn't really mirror exactly the yen chart, but it's pretty darn close, right? So this is like the Fed's panicking and everything's blowing up, and now we've got this counter trend move. I wouldn't read into it the exact same. I would really pay more close attention to the yen chart. But if we see another aggressive leg to the downside out of rates, which would probably only happen if Jerome Powell had the right combination of words on Friday during Jackson Hole. If that's the case, then maybe we're getting a panic button. But as of right now, I like the soft counter trend move in here that's kind of keeping rates stable. If rates can stabilize, I would argue that that would be bullish, lower volatility in interest rates for the equities market as a whole. As we take a look at the inverted ZT for the 2-year yield, you can see the same thing, a small drift in the upward direction. If it really takes off to the downside again, probably the panic button based on something that Jerome Powell had said. Speaking of Powell, let's go on over to the tracker tool and see what's going on from this point of view. If we take a look at the odds, they are now about 75% odds for a single rate cut on the September meeting, that is on the 18th. And if you recall, we had been going back and forth between 475, 550, which is a double cut versus a single cut. The market, I think, is making the right choice here after the data we got last week. If we take a look at the calendar and just go over it all, the PPI beat the expectations. That is bullish. Inflation's coming down, and obviously rates have remained pretty stable up towards this the top of basically policy we've seen in a long time. So inflation's continuing to come down. It's not resurging. We also saw the same thing out of CPI. My only issue with CPI was if you actually took a look through the detailed report, shelter costs, I think that's this chart over here. Yes, shelter costs are still way too much of a contribution. I think that they were up month over month about 0.4. We don't want 0.4s. We want 0.2s out of shelter contribution. So this is year over year contribution. Month over month was a 0.4. We want 0.2. Generally, what I'm saying is that the risk of cutting rates for a double cut would just mean that shelter inflation is going to tick back higher when financing costs get lower, right? So that's something to at least keep an eye on. As we jump back on over to sort of recap the information we got, we also saw a strong number out of core retail sales and retail sales here. So the consumer is still spending. That's bullish for the economy. And the jobless claims actually beat the expectation by about 10,000. So the labor market's not continuing to break. Therefore, it's not really an emergency rate cut. And this whole sort of idea that, oh my God, markets are breaking down and everything's going to go to zero, we're going to fall into this recession. Last week's fundamental data really turned that story around just a little bit and said, no. Don't panic so fast. There's still an opportunity for a soft landing. I know you shouldn't hold my breath on making that claim either. What else do we see here? The Empire State Manufacturing Index beat the expectation as well and was higher than the prior. That's, again, bullish from an output perspective. The Philly Fed's not as important, so we'll just really focus on the Empire there. Building permits and housing starts came down, which the market didn't really like in the pre-market, but at 10 o'clock on Friday, consumer sentiment was positive and inflation expectations remained stable at a 2.9, which is not. It would have been better to see a 2.8 handle, to be honest with you, but it's not bad. It's really not bad. So all of this combined would start to suggest that the Fed can cut rates, but probably responsibly and slowly. The reason that we would want to cut rates as inflation is coming down is because growth wants to continue to stay stable at its sort of forecast and avoid, or I should say to avoid a recession rather, you wouldn't want negative GDP prints. And if we look at what the Atlanta Fed just estimated on Friday, or into the end of the week really, there's a pretty sharp downtick out of their estimate. Now, don't get me wrong, a 2% growth here is not the end of the world, but just generally the magnitude of this revision, if you will, I think loosening up policy wouldn't be the worst thing in the world, right? As we continue to take a look through the other fundamental data, let's firstly go on over to what we can expect this week. Then we'll talk about earnings. Let's get a little bit of a load. There we go. So we're getting some Fed speak, which is interesting because Jackson Hole is later on in the week. You can see day one is here on Thursday kicking it off. Powell speaks at 10 o'clock. I believe that's either his keynote or a sort of panel discussion with one or two other participants. But generally, that's when you're going to get the most volatility. So Friday, be on the lookout for the comments we made on the TNX and the inverted ZT. Prior to that, though, again, sprinkled in some more Fed speak. FOMC meeting minutes likely won't change the tone of the market. We already saw the data from last week, so we're all set there. Initial jobless claims will always be a good one on Thursday, considering how sensitive the market is to that stuff right now. And manufacturing PMIs, I don't think, are going to be nearly as important as what we saw from services PMI. So flash services, yes, maybe. But the ISM report, which we already got 2 weeks ago now, was much more important. So in my view, not the end of the world here out of the calendar. We're really focused on any sort of slip of the tongue from Jerome Powell on Friday, August 23rd. And we know that he's likely going to talk about, the data came in good. We're going to remain data dependent. It's very likely that we're preparing to think about maybe possibly cutting rates in September. If he slips that one out there, obviously you're going to see the odds just like totally solidify there. It's really about the pace of rate cuts going forward. And I would also bring in, let's start talking about earnings because I think this is interesting. Earnings growth is somewhat related to the interest rates out there, right? Obviously, in an easier operating environment, you would look for higher growth out of companies. When we had ZERP, we were looking for insane growth out of all the technology companies. Now, notice that technology is still up here, but generally speaking, recently, right, if we take a look lower, as rates have been coming down in anticipation of the Fed rate cut, as I scroll, geez, maybe it's on the wrong tab for this. Where is it? All the way down here. There we go. There it is. The actual PE ratio of the market has sort of been stable, right? You would expect this to really take off if the operating environment was going to get easier and interest rates were going to come down. So the whole reason that I'm sort of bringing this up, if we just go back up to the growth forecasts there, and this is like calendar year 2025, I think that if you're going to hit these numbers out of the heavy hitters in the companies, but you don't want inflation to come back, rearing its head like crazy, then I think that the delicate balance that needs to be struck is interest rates can come down softly, 25 basis points at a time, and possibly even spread out. But if I go back on over to the platform, then we'll take a look at the calendar upcoming. I want to show you this, and I'm getting a little outside of my wheelhouse, little bit here. But this is the Fed balance sheet, right? The total assets that they hold. As long as we continue to see a roll-off of assets from their balance sheet, I don't think you're going to really... the easiest analogy for all the internet people, right, is just Jerome Powell's not going to turn the money printer back on. As long as you continue to see assets roll off, I would like to think that the progress on inflation can stick and we can see rates come down respectfully as long as this sustains itself. So in total, one of the things that I'll be thinking about or watching for, listening for more appropriately, I should say, is whether or not Jerome Powell addresses what the state of the balance sheet is going to look like. Are they going to continue to roll off assets, or are they going to start increasing their holdings? We don't want to hear that they're increasing their holdings. That would be inflationary as they're also bringing down rates, right? So trying to tie that together, again, maybe I'm not the best person for it, but I'm just giving you sort of an idea of what I'm looking at. The earnings calendar for the upcoming week will be interesting. Palo Alto's a leader. We're going to watch for them after the close on Monday. Cyber, right? Lowe's will be interesting. Home Depot already reported, so is the sympathy already played out? Possibly. I'll look for Target just to see more state of the consumer. Walmart had noted in their call that the consumer's still spending just fine, no issues. So we'll see if Target can sort of reinforce that. Snowflake is interesting. Zoom is trash for cash. Or cash for trash, I should say. Baidu, not interested. That's really it. Pretty quiet week out of the earnings calendar. Some of these top row, is really what we'll be focused on. Let's jump back on over to the platform. Let's finish up today's episode. I don't know how we're doing on time, but it feels long already. Let's jump into the TLT ratio to the S&P. This pullback is what I was referencing as the TLT chart itself was really wedging, right? That's this up here. I don't know why I just didn't draw it up there, but you get the idea. There's the TLT. Let's jump into bonds relative to themselves. This is really interesting. This, as it was trending down, as this was holding sideways, recession. As this now starts to a lower high trend, or a downtrend generally, lower high, lower lows, that's more indicative of, hey, just generally rates coming down, not so much recession. The longer end of the curve is also responding, which typically the Fed has less control over, right? Let's jump on over to the credit spreads, which of course have contracted massively, big pullback, and it did not hold for a higher low above 0.88. So seeing this remaining below with the short duration spreads, if I just do this, you can see this. See how rapidly that's already down on the lows? That would sort of indicate more of a bullish stance for a risk appetite, right? And speaking of risk appetite, HYG in isolation, massive higher high from here to here, whereas the S&P still has a lower high. Right? So that is a bullish divergence, speaking to, yes, the flash crash is likely over. And we've really only identified, what did I say, like 2 or 3 bearish charts that maybe tell you to be cautious. Bitcoin, maybe underneath the bottom end of the range, could be a small caution, but not the end of the world, trying for a higher low. I would be really bullish on the, well, maybe not really bullish, but more constructive for continuation to the upside if Bitcoin, a risk asset, breaks out and really accepts over 60,000, let's call it 61,000 for round number's sake. Let's jump on over to the total breadth charts. This looks great. Upticks out of the SPX A50R, 200R, new highs versus lows, staying positive as well, not accelerating underneath zero. So breadth is checking out here as being bullish as well. Let's jump into the RSP. Also bullish, coming up into the equal highs. It did not reject. Once again, think about this like we did in the sectors. Was there an opportunity for a lower high? Yes. Did the sellers take it? No. That is bullish. And again, confirmation from breadth would mean, likely to see continuation here as long as this remains stable. The next step would be a higher low above. Same thing could be said about the QQQE, where you've got yourself a move in tandem, right? So here's the equal weight into the highs, and the same thing out of the weighted down below into the highs. So this is all set. It's not divergent. I would be more concerned, and I would say, yeah, it's a no-brainer short in the NASDAQ if this was still underneath here as the weighted NASDAQ was above. It's just simply not the case. They're actually moving in tandem. Let's take a look at the VIX, because the VIX has come down aggressively. This is now on a logarithmic scale, just so the spike is not looking so odd, in case you're wondering why the y-axis is weird. But generally speaking, we're sort of still in an elevated volatility state. And I think the thing that often goes overlooked is you can have volatility to the downside, you can have volatility to the upside. Volatility has not really, this is telling us it's subsiding here, but that's the classic, like, buy far out of the money puts, right? And that's what causes your VIX to spike in the first place. So I think there's still, what I'm saying is I don't feel as though this is an accurate representation of actual volatility. It's still elevated. And you can see this if you just jump on over to, let's go to the VIX over here. And if you take a look at the volume that flowed through, you're getting 5 times the average volume in the VIX, and you're seeing that people are still loading up twice as many calls versus puts on the Friday session. Again, it doesn't feel like the VIX pulling back here is actually an indication that volatility is through with. If we take a look at the VVIX, this is actually telling us, no, you're right, it's not, and you're still not even close to the comfort zone down here at 75. Let's jump on over to the vol futures, and they have worked their way back into a contango. Same thing, 9 versus 30. The 1 day is underneath that 1275 key level. So I think it'd be irresponsible to say, like, everybody's preparing for another market crash. It doesn't seem like that, excuse me. But it also doesn't seem like we're out of the woods completely. And again, volatility cutting both ways is really the point that I'm trying to make. You can see just as much volatility in the upward direction. Let's jump on into the core list of companies now. Let's get the job done here, and we'll get you on your way with those 2 additional ideas. First up, Microsoft. Let's take a look. So similar thought process to the sectors. Was there an opportunity for a lower high? Did the sellers take it? Yes, and then no. So the fact that we're over 416 to me is constructive. The fact that the sellers are not stepping up here means that we have buyers who are more aggressive. And if there's a higher low, even if we fail 416, I would look for buying opportunities here up and over 408.75. So that's my take on that. Obviously, consolidation here is also bullish. The next major level is through this consolidation into the high at 432.15. Here it is on the hourly time frame chart. You can clearly, see the uptrend here. Any consolidation over 416 over the 2 equal highs. First target, second target, lower high in here. Great. You could try the short from A to B, but at point B, because of the daily, right, breaking over this level, I'd be thinking about reversals here for moves back in the upward direction. Next up, excuse me. It's really that change into the season. Fall is a-coming. Apologies for the coughs today, folks. Thanks for bearing with me. Apple is up next. Big move into this area. Slow grind in the upward direction. I would start being a little bit skeptical of Apple just straight up continuing. We typically don't count candles, but this has not had a single red day in, 2 weeks or whatever. So I would think that consolidation here sets up the better trade. When I say sets up the better trade, it doesn't mean that we have to get this. But if we're going to participate in a risk-friendly manner, I would prefer that we get a consolidation here than offering a breakout through this, which is identical to what we've sort of talked about in the S&P 500, right? This Brigade bolt moving into the highs. So Apple watching for any higher lows to really persist over 218.50 would be the level that I use. Absolute line in the sand, 214. Would I want to long it right here at the equal high? Not really. There's not even thin structure off to our left, right? This is like, choppy and grindy in that previous day's session. So I don't really like the long out of Apple. You can probably hear it in my voice. Next up, we've got NVIDIA. NVIDIA is worth it on a daily time frame chart to take a glance first because there's this huge recovery over the neckline. Once again, did sellers? Yes, they had the opportunity. Did they take it? No. So any consolidation, any higher low pullbacks over 118 going forward, really bullish. I'd be thinking about the equal highs, if not possibly into the all-time highs as a pre-earnings run-up. If this is all like a big shakeout and you're going to get people who are screaming from the rooftops, oh my goodness, AI is nonstop and NVIDIA is going to blow it out of the water on earnings. I think that the pre-earnings run-up might look something that looks like this. I'm not going to be trading explicitly for that, but if it unfolds, then we'll sort of be able to identify, okay, this is what's taking place. We know our point A, point B, point C, and we'll take it from there. Any straight up continuation, just like everything else we've talked about so far today, feels a little bit chasey, risk reward into known areas of resistance, not really ideal, right? So on the hourly chart, just as an illustration, right? If you're going to take a breakout of the previous day's high, that means that your risk needs to look something like this box here, and your reward is into this resistance. Not really great, versus like maybe a pullback into this, double bottom. Now we can go risk, okay, better reward up towards that level here. So trying to navigate things like that out of NVIDIA, I know it sounds like a rinse and repeat of the broad market, but NVIDIA basically is the broad market, as we all learned through the early stages of 2024. Lower high, Google is the weakness monster. Relative weakness, no rally, no nothing. Everything's an inside bar after the Monday gap down from August 5th. So keep it simple. There's nothing to do here until you break out a 165 or break down underneath 156.50. One of the trades that we actually set up, and here's a little X post on the screen now, was a fade off the top end of the range here into the end of last week. Good for a couple of points. We'll see if that can continue into the Monday session. I'm not, just full transparency, not holding any of that over the weekend. Typically don't hold positions over the weekend unless it's a long-term account, FYI. But generally, Google pullbacks off the top end of the range are kind of in play first, just because of how weak it's been relative to the broad market. Next up, Amazon. What do we see? A little inside bar range here. Simple. Swiss cheese above, Swiss cheese below. You've got a gap underneath you into the high of the Wednesday session, 172. Nothing to do, almost similar to Google, but I would say a bit more constructive because the gap range gives us a framework to use. Nothing to do until you're over 178.25 or under 174. With a line in the sand on the pullback, I would entertain this as a pretty strong opportunity as well. Possible higher low here at 168.75. Possibly a reversal of trend. We did not make it into the equal high, and obviously that's due to the earnings gap down, but it's trying to be constructive in the gap close overhead. Next up, Metaverse. What's going on with Zuckerberg in the fantasy land? This one looks like it could possibly pull back. On the daily chart, you're seeing some slowdown, some consolidation, whereas the broad market accelerated on the Thursday session. And this had already made a wall-to-wall move. Here's the top, here's the bottom, wall-to-wall and some. It would seem reasonable that some either digestion or a pullback would, sort of start to be the next process here. On the hourly chart, you're probably shouting it from the rooftops. Here's your head and shoulders under the neckline. Pullback. This is not a big short where, oh my goodness, we're shorting this thing into the ground. I would tend to think that your neckline breakdown is good for a scalp here. And then the better short trade is if we fail underneath 517.25, just because there's more range. But even at this 503.50, I would then change tone to start looking for this, noting that the daily wall-to-wall move would be supporting over what? This area over here. Right? So now you just have a huge opportunity for a higher low, and also icing on the cake, it's over the previous balance lows. Next up, Tesla. What do we see out of Mr. Musk? The rocket ship's trying to rocket ship. It's coming into resistance, so I would start to dial back continuation expectations. It is ultimately in a downtrend with highs, lower highs, lower highs. Possibility for lower highs here up against the bottom end of the previous range at 215.25. Kind of a lack of acceptance, to really accelerate above on Friday. I would use that as your price judge, really. If you're over it, I would tend to think that continuation is likely. If you're under it, I would start thinking about a deeper daily pullback, something that looks like this. Just to retest the top end of this range at 202.75, trying to pick up longs here if the reversal is going to be more meaningful. The reason I say more meaningful is just because the downtrend is still intact. This is not like the broad market. It has not made an equal high. Next up, JP Morgan. Financial sector we just saw was on fire. JP Morgan is on fire. Two things here. Risk reward into the top end, not really ideal. Known area of resistance, rejections in here, leaves a bit to be desired. So continuation, look above and fail. Great. Looking for shorts, point A to point B, not overstaying your welcome at point B, 209.50. Then thinking about double bottom reversals back into this. If we can set a clear higher low and equal high reattempt, blue sky breakout is the name of the game. So if you're like, why would I bother with a point A to B short if I'm looking for a blue sky breakout? There's nothing wrong with that. Like, you don't have to take this short trade, but what I'm saying is like the risk reward here leaves a bit to be desired. So I would prefer to see this pullback and then a breakout. If we do just get a big continuation move, let the balloon float away. There's likely going to be some sort of back half retest over the top end of 215.75. There's your Brigade bolt, right? Next up, Netflix. What do we see? This is just like, it's got a mind of its own. This is horrible price action over here. It started to perk up a little bit, so it's worth paying attention to a little bit more so now. This level is really interesting at 663.75, inverted hammer on the Friday session. If we break down underneath the Friday low, I would think a pullback's reasonable. Any pullbacks that can hold this start to loosely, very, very loosely, imply inverted head and shoulders, pie in the sky perhaps, and then, maybe it's off to the all-time high. That's a little bit, it's asking for a lot. The reason I would say that, though, is because we do have thin structure on the upswing. So if it is going to do it, show me the head and shoulders on the hourly, give me the breakdown, then finding support here would be more interesting for a swing back to the upside. If it just grinds around up here, I would wait for the consolidation to prove, right, that it's doing something interesting here, and then possibly the Brigade bolt there is your interesting trade over 683 into the all-time high at $700.99. Don't you forget it. It actually was 1 penny shy of the round figure. AMD, some updated levels on AMD. The chart was getting too cluttered. It was not really cooperating, so some updated levels. The chart's still, it's not like we are forcing it to cooperate. It's not great, but hopefully this makes it a little bit more clear. This is a great area for a rejection. You can see the severe reaction to the downside, severe reaction to the downside, prior support, right? So looking for 150.75 rejections, your higher low, if it is going to be constructive, is over 143. And I would even argue that this is possible as well. 136, top end of this range, which is broken out reluctantly, but it broke out. So that's the AMD watch. Wouldn't really be long into this area of resistance. I would tend to think that if this breaks, great, let it build out some sort of consolidation. Maybe we'll have to update levels again. And then the better long trade is honestly through this thin structure overhead. So I know it's got a lot of work to do, but something that looks like this, consolidates, digests the move or whatever, this move in the future would be what I would ultimately be waiting for. Right, thin structure retracement. So waiting patiently out of AMD, patience is not a bad thing to build as a trader. Let's move into two trade ideas. AVGO is the first one for us. This, of course, is Broadcom post-split. This is still an hourly time frame chart, so we'll go back to the daily to start. Generally, the concepts are the same. So if this is a resistance trend line, we, of course, have broken that. You've got an inside bar on the Friday session, classifying as a 3-bar play. You have bar number 1, bar number 2, inside hammer, over the inside hammer high. You could even be patient for the recapture of this level, Thursday's high and the low of this bar from back here. Over 167, you've got some clearance into 172.50. So about 5 points of upside to be trading for, absolutely worth your time for watching. This is in play as long as it's over 160.75. Here it is on the hourly time frame chart, just so you can see it, right? So would it have been reasonable for some pullback? Yes. Did we continue to pressure those highs? Yes. Inside range, this is exactly that, a balance. Looking for that balance to resolve with some excess into the next level, 172.50. That's AVGO, Broadcom. That is obviously tied into the semiconductor space. Next up is going to be Uber. Not related at all to the semiconductor space, and this is actually the opposite. This is a short trade on 2 back-to-back inverted hammers off of a very clear and obvious area of resistance. You've got a wall-to-wall move, 100% retracement. So it's not bearish per se in the sense that we're looking for this to go to 0, but it's probably executable for a pullback into this breakout point at 69.20. If you're underneath Friday's low, 71.75, looking for a thin structure retracement to test this, probably could have even extended that off to the left. Yeah, look at that. Previous rejections, support, 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 right? So a pretty historical level there at 69.20. As we go back down to the hourly just to take a closer look, notice how on Friday we looked into that Thursday session range, really failed at the high of day there, and then all of the acceptance was under this pivot right here. So it's sort of already setting up a Brigade bolt underneath the low of the Thursday session. You're just looking for another one basically underneath the neckline of the head and shoulders, right? There's your head and shoulders, Brigade bolt lower high, rotating into the breakout point here at 69.20. That is going to do it for today's episode of the Weekly Watch List. I hope you enjoyed the episode, although it was one take and perhaps a little bit rambly at times. If you learned something new, let me know down below in the comments section or by giving the video a very simple thumbs up. It always goes a long way to support the channel. And with that said, I wish you a green trading week. We'll be up in the penthouse at 8 o'clock on the Monday morning session for our usual pre-market prep. We hope to see you there. Once again, enjoy your weekend, have a green trading week, and I will see you in the next one.